Hey there guys, it's Curtis here with Long Trend. I'm a CFA charter holder and web developer, and it's my job to help investors uncover quality stocks by showing them how I analyze stocks using the web-based tools that I created. Each week I'm going to work through a stock and try to determine if I'd be interested in buying that stock at the current price. Now, analyzing stocks isn't always easy, but it's always fun, so stick with me and let's get into this week's stock. Alright guys, so up this week is Google, or Alphabet as they like to be called. This is the California-based internet behemoth that was founded in 1998 from a Stanford dorm room by Sergey Brin and Larry Page. Yeah, these two guys. Together, these two men still own about 14% of the business, and they control about 56% of the voting stock. So everyone watching this video is a consumer of Google product. They own search, they own video, they've got Android, and they have Chrome, and all of those products now have more than 1 billion users. They also make smaller, more unconventional bets in technologies that are unrelated to these products. Why? Well, first, because they can, because they have the cash to do so, and second, because they're looking for the next avenues to grow their business. Alright, so that's enough of an intro for Google. Let's get into the model. So Google is a very large company. They are a $1.7 trillion enterprise value company. This is a monster company. There's only a few companies on earth that are this big. Of the enterprise value, 1.8 billion, which is higher than the enterprise value, is actually stock market capitalization. That's the value of all the public stock outstanding for Google. The reason why enterprise value is lower is because to market cap, you add the debt. Google has about 26 billion of debt. Then you subtract their cash. And Google, because of its size and its profitability, they have a lot of cash. They have $136 billion of cash. So 1.8 plus 25 less 136, 1.7. Directly below enterprise value, I calculated an enterprise value or EV to EBITDA multiple, which is right now it's at 25.7 times. Now, that's higher than it's been historically. The whole market is, frankly. And if you look historically, over a 10-year period, it's averaged about 17.5 times. 5-year period, they've been 18.6. 3-year, 18.9. At the end of last year, that 21.7. And right now, they're at 25.7. So this is the richest valuation that Google has ever been at. But that's similar to the other large tech companies. They're generally all trading at their highest valuation. So directly below that, I also have net debt to EBITDA ratio. This is negative. Negative is a good thing. That means they have more cash than debt. So that's good. Debt is not a problem for Google. So scrolling down into the operating assumptions, Google's actually been growing like crazy. It's one of the fastest growing tech companies, and it still is growing very fast. Over a 10-year period, this is a compounded rate of growth. They've grown at 20% a year. Imagine growing something that's worth now over $1 trillion at 20% a year. Even last year, they grew at 13% a year. I mean, that's a great growth rate for a company of their size. The thing about Google is that they get to a particular size, you have to assume a slowdown in their growth rate when you're modeling them, because if they keep on growing at that kind of clip, well, they're bigger than the entire US market, which isn't reasonable. So what I actually do for Google is I say, okay, so let's walk it down. By 2031, I'm not going to give them more than a 5% perpetual growth rate after that. I think that's reasonable. I think that's fair. That's going to be lower than they've ever been growing at, and you can't assume much higher than that, otherwise they just get crazy large. Okay, I'm going to quickly start moving down through the operating assumptions. EBITDA margin over the last 10 years has been about 30%. So that's what I'm going to use in the model. That's a good margin. You're keeping a third of the sales. Next, as a percent of EBITDA, both share-based comp and depreciation are large. So I'm going to include those as well at a 3-year average. Next up, they spend about 15% of sales on CapEx. That's the highest CapEx rate over the last 10 years. So it's a conservative assumption for the amount of the maintenance CapEx required. Next up, current tax and deferred tax. I'm actually going to increase this. I'm going to say it's not 13%. Let's use 21%. 13% might be a bit of an anomaly last year. Deferred tax is negligible. And then cost of interest, cost of debt, again, I'm going to pass through those quickly because they're kind of not important for Google. Okay, so in the free cash flow section, I'm going to change non-operating income to the 5-year average. This isn't a perfect way to model this, but there's often a lot of noise in non-operating income, write-downs, stuff like that. So I'm just going to make it more of a benign number. And that's actually better. It's more conservative for Google, and it doesn't really, frankly, move the needle. So let's jump all the way down to CapEx. 36 billion of maintenance capital next year, growing up to 91 billion over time. And then look at free cash flow. 22, 30, 43, 50, and then growing eventually to over 100 billion in free cash. That's assuming a dropping growth rate from 18% to 5% over time. So the curve will kind of flatten out. Okay, so next up in the sources and uses section, Google does not pay a dividend. That's a discretionary thing that their board gets to decide. They don't have to if they don't want to. It's nice to receive a dividend, but it's actually not relevant to the valuation of a business. The shareholders' claim on that cash is the same, whether they receive it as a dividend or whether Google keeps it on their balance sheet or use it for an acquisition, or they use it to buy back shares, or maybe they use it to delever the business. The shareholder gets the same claim on that cash. So instead of paying a dividend, what Google does, they actually buy back a lot of stock. So over a 10-year period, they bought back 10 billion, 18 billion over 5 years, 24 billion. These are average rates. And then last year they did 37 billion of buybacks. I would actually expect that to increase. If you're going to generate free cash flow of 50 billion going forward, you're going to do more than 25 billion. But I'm going to leave it at 25 billion flat. It actually doesn't change the expected return calculation. I either use that cash to cancel shares and the share count goes up and the share count goes down and the stock price goes up, or I add that cash to the ending enterprise value and I get the value that way. Google doesn't do a whole lot of acquisitions, and they have an immaterial amount of other sources and uses. I'm actually going to change it to a more benign number, which is about $1 billion. Okay, so we'll say $1 billion a year. And then look at this. So if Google doesn't increase their share buybacks, or if they don't pay a dividend, look how much cash they're going to put on their balance sheet each year. So next year it's going to be 20, then 28, then 35, then 43, then 50. So that's why Google's probably going to pay a dividend, or they're going to increase their share buybacks. They just have too much cash. They can't let their cash get a lot higher than 135 billion or 200 billion. Shareholders will start to ask for it back. Unless Google has a better opportunity to deploy that capital internally, and then they'll make that widely known to shareholders. Okay, so down to the expected return section. So again, Google does not pay a dividend, but you can still calculate an expected return on a company that doesn't pay a dividend. The math is the exact same. It's still an internal rate of return calculation. So the way this math works, I can go into the market today and I can buy one share of Google for $2,800 a share. If they have the revenue growth that we've modeled, if they maintain the EBITDA margin that we've modeled, and they have a 17.5x exit multiple, which is the lowest that they've had over a 10-year period, the stock should be worth around $6,300 a share. That would work out to about a $3.8 trillion company. So that's a very big company. I mean, it's surprising to have any trillion-dollar companies. That's such a big number. But it's also the first time in history that any company's ever made 65 billion or 100 billion or whatever in EBITDA and cash flow. That's never happened either. Now, it's always good to flex to the downside, so let's go and do that. The exit multiple of 17.5 is already conservative. It's the lowest it's been. Google's such a high quality company. I don't know if it's going to go that much lower. Maybe you could go to 15. Let's type in 15 just for argument's sake. Growth has been slower than 18% in the last year. So why don't we make this 12, 12, 12, and then 5. And then everything else looks pretty good. We're already using the highest CapEx as a percent of revenue. We've got a decent tax burden. And all the sources and uses are funded. I mean, we're still putting cash on the balance sheet in a big way. They can easily increase their share buybacks even at that rate, and they can pay a dividend. Okay, so the downside for Google to me by buying right now at 25.7x is 5%. The upside is 8%. If they're still growing at 12% in 2031, just for argument's sake, and they're going to have a 20x EBITDA multiple if that's the case, well, then it's got a 10% return. So it's still not a slam dunk. It's not a home run. 10% is not bad. It's probably still a market-beating return over the next 10 years. And what you get to own is a small stake in probably one of the top 5 companies of all time. Okay, guys, so to wrap this up, am I a buyer of Google at these levels? I'm not backing up the truck, but I'm not selling either. You could dollar cost average into it. This is a very high quality business, one of the best that you'll find. The biggest risk, of course, is the multiple. It's trading at 26 times enterprise value to EBITDA. You know, you have to project a multiple contraction over time. Does this company have any debt problems? No. Do they have any growth problems? It doesn't look like it. Do they have any problems with their margin? No. So it's got a lot going for it. It's just the multiple's a bit high. Hey guys, thanks for watching. So that's it for Google this week. If you liked what you saw, please hit that subscribe and make sure you like the video. I'd really appreciate it. It would help out the channel. Next week, we're going to have a look at Kroger, the large grocery store chain, and I hope you'll tune in for that one as well. Thanks a lot.